All right, everybody, welcome back to the Cashflow Chronicles, July 30th, 2024, Season 2, Episode 13. Apple barely moved since the last time we hung out. Amazon as well. Dutch Bros about $38. Google about $1.70. Palantir still hanging out at 26.5. SPY has barely moved either, about 5,400. The Q's hanging out. Bitcoin went up, went back down to 66,000. And oil prices retraced a little bit back down to 75. And nobody likes Henry Hub natural gas, $2.19 or so. Be sure for anybody that is new to the channel to hit the like and subscribe button. We are trying to do 2 episodes a week and have so far been pretty successful since we kicked off season 2. Mr. Patel, how are you doing?
Good, man. Went to go see Deadpool with the wife. We caught a matinee today.
Yeah.
It was a good movie. It brought back a lot of nostalgia. Yeah, I thought it was worth it. But I mean, it's definitely not like Top Gun level where I went to go see Top Gun like 3 times. You know?
Really? Dude, Top Gun, the new Top Gun was actually, I was very surprised. I'll tell you what Marvel movie that came out in 2024 that was not worth it, and I should have listened to my buddies. Madam Web. I should have. I literally was just watching. I was just like, I'm a fan of Dakota Johnson. I think she's attractive. Whatever. Let me watch it. I was not. I fell asleep, and I was just like, I'm not even gonna finish this. I was like, I got to go upstairs and get ready for this bad boy. So,
yeah.
But Deadpool's funny. Yeah, Ryan Reynolds was a good time.
Yeah. The story could have been a little bit better, but I think the acting was good enough, and like there was a huge nostalgia factor into it too. Like. They had a lot of cameos, which kind of made it very interesting. Yeah,
interesting. Well, how's your portfolio been? We have some updates in our portfolio we have to share, but I'm curious how yours has been. Mine's been up, it's been down.
It's been good, actually. You know, I think I remember saying this. I've been in 3 different sectors, and they've done really well. So it's been regionals, REITs, and reoccurring revenue, right? So regional banks have done well, and in which case, once we see our portfolio, that should be a little bit clear. REITs are doing well too. So our BPYPM position, and I have a few REITs in my portfolio. They've been doing okay. And last but not least is reoccurring revenue. So businesses like AMT and CCI, which are kind of a recession-resistant Verizon, which are recession-resistant because it's, a lot of the businesses that are going to be, a lot of those businesses are not necessarily impacted by consumer weaknesses. So I think overall my portfolio is. I got a little bit of ahead of the market a little bit and just said, you know what, it's time to be a little bit risk off. And I'm catching a lot of the great plays on because of that. Tomorrow, Norwegian reports. So I'm hoping that like all the data points that I'm looking at is telling me that they're going to have a beat and raise. But, you never know how the market's going to react to these things. So sometimes you just have to,
and it's going to take a couple quarters, right? Yeah. I mean, your thesis is rates are going to come down. They're going to be able to refinance at cheaper rates and slowly get the net income margin back up to where it was pre-pandemic. I mean, the traffic is already there, right? So it's really just about getting that margin back to where you want it to be, and things are going to flow swimmingly. And I'm actually pretty surprised because going back to REITs, one of the things that I've been trying to think, like, me, I'm trying to consolidate my portfolio a little bit because now it's kind of getting unwieldy. Like if you have so many large positions. So I'm like, let me get the one big position, which is the SPY, and let that bad boy do its thing. And then I have my smaller, little plays that I like to have. But I still have this one little position that's like 30, 40 grand. And it's Stag Industrial, single tenant acquisition group, warehouse play. 3% of their revenue comes from Amazon, like all that sort of like piece, right? But I've been surprised. I was looking at their, we always talk about the debt roll, right? What's coming due in the next couple of years. And I'm just like, how the hell did these guys are killers. Like I'm looking at their debt to come due, and later, like they have barely anything in 2024, a little bit in 25, and it's at 4.5%. They just pulled out 500 million. That's going to 6%. But the rest of their stuff out to 2030 is in like the 3 and 4%. I'm like, how the hell did these guys, and they're just pulling out a 6.5% now? And I'm like, how the hell did these guys swim through this like nothing ever happened, and it's just impressive. So I mean, I'm glad I never sold the stock, because I was thinking about it probably like 15 to 20% ago. But in reality, I've been thinking in the back of my mind, so I'm like, well, interest rates getting cuts going to be helpful for real estate, and it has been. The tailwind on this thing has been absolutely massive. And same thing with SLG. I'm still holding on to that. It's above $65 now.
And you've been selling covered calls on it, right? And
yeah, I've been selling a lot of covered calls, and so no puts. I did sell some puts back when it was still in the 30s. And those did well, but I haven't sold any puts really since it crossed over the 40 mark. But I have been selling covered calls the whole time. I'd actually be kind of curious to see how much I've made just on the covered call side. That'd actually be pretty interesting.
Because you made a shit ton of money on the stock, and then you layered on top the covered calls.
It's up 200%. I mean, it's insane, and I don't really plan on letting it go. It's getting to the place now. I've been talking.
And it pays monthly. It fucking pays
monthly. Yeah. So I'm like sitting here. I'm like, all right, unless I find something that's beautiful, I'm definitely going to keep some of it, because I think the dividend is still, pretty good. I think it could get to the 80s, no problem, within the next year or so. So I'm like kind of sitting there and like, all right, well, that's going to do its thing. But anyway, I've just been surprised by some of these positions where you're just like, it's dead money. But it really goes back to just knowing the market and knowing what's kind of going on to give you a little bit of that edge,
Yep.
So, cool. All right. So let's just take a quick look at the portfolio piece of it. You and I both had contributed about, let me know if it's showing up.
Yeah, it's showing.
Cool.
Yeah.
Let me see if I can move this to the other screen and move this here to make it a little easier to control. Very good. So you and I both, you sent me about $250. I freaked out because I thought you sent it to the wrong Zelle address, but no, we got it all. I was like, TD Bank. I was like, oh my God. So anyway, we're all good with the respect to that. And I added $250 myself. So the portfolio is taking a little bit of a jump in capital. And speaking of that, we should be able to reapply for monetization on the channel tomorrow. So I'm just, once I have a minute tonight or tomorrow, do one last glance, make sure everything's good, and then be prepared for tomorrow. And I'll get you on the horn so that we're all together going through. So hopefully things can go swimmingly with that. But our bets that we have, this is in alphabetical order, not by total value. So I apologize if it's a little bit confusing. Some of the things that we did add when we added the $500 in capital was ASTS. I believe we added a little bit more BPYPN. We added some DPST. And I might have added a little bit more TMF. I'm trying to remember exactly what exactly we did. But we added about $500 in capital. We only have $38 left. So all of that pretty much has been deployed. Mr. Patel, your thoughts so far?
I think we're doing good. I mean, for the year, we're up pretty nicely. I think we're pretty much hedged against a lot of the issues with the recession that are going to be coming in. I mean, the one that we bought one share of Celsius just to track it. That's right. Not really not as a huge investment. ASTS is the same thing. We just bought that as a tracking thing. We're not really like concentrating a lot of our attention and positions of that. So I think for the most part, our positions are pretty well balanced, so we'll see what happens. I think one of the good things is that we are not tech heavy right now. Tech got to the point where the valuations just absolutely went haywire. And so we just have to be cognizant of that. And I'm glad that we're not in any like semiconductors or any even application software, because I think they're going to get hammered, and it's going to be like this for a little while the rotation happens. So
yeah, and one of the things I've been noticing that like goes up and comes back down, goes up, comes back, is this TMF and DPST position. Like they're just like at the bottom and they're teetering up. Like it just want to blow it, And I think tomorrow, speaking of the reason why we're invested in it, is really the Fed decisions, right? And so tomorrow we'll have Jerome Powell talk about what's going on with respect to the July decision. I'm expecting there not to be any sort of formal movements tomorrow. But I think what the big thing that's going to be is the vocabulary that he uses, right? What definitions is he saying? What is he exactly hinting towards? What kind of data are they looking at? And is he going to point more towards hawkishness or dovishness, I guess, going into September, because there is no meeting in August. And I'm curious to hear what your thoughts are. I know what your thoughts are, but I'm curious if they've changed at all or if they're staying the same.
No, I'm pretty sure he's going to be relatively mild in his commentary about, when rates are likely to be cut and everything. And so I think today's retracement kind of helped a little bit, because I think, it kind of, the Fed always says, like, the stock market is not really a concern for them and blah, blah, blah. But dude, that's bullshit. At the end of the day, if the stock market takes a dump, the economy takes a dump. But if the economy takes a dump, it's the Fed's job to basically, like, help us navigate around that. And so that's just how things are. It's just one of those things that they're going to have to deal with. Now, one thing I will say is, we're still not at a point where there is a guaranteed rate cut coming in September. I know a lot of people are pretty much expecting that, and the market is kind of pricing that in, but last minute data could really throw that out the door. So I'm keeping my head on a swivel right now. Everything that I'm seeing is telling me that we're likely to see cuts. Oil prices are starting to back below the 80s again, which means that there's probably going to be forward drops in energy inflation. Natural gas prices are lower, so once again, that's another factor that's going to contribute to it. And with natural gas prices being depressed, you're also going to see fertilizer prices depressed. So food prices are going to hopefully stay moderate, because a lot of natural gas goes into fertilizer production, and then also for just normal heating and cooling and everything else. So, the price of natural gas has a really big impact these days on the electrical grid also, because there's so many electrical plants that use natural gas as a feedstock. So we're moving off of coal, but we're going into natural gas, and the renewables haven't picked up steam yet to do a complete replacement. So I would say overall, everything is looking like we're headed into a strong disinflationary trend. My worry is that trend is going to continue, and we might end up getting deflation, especially if shelter, like we've been saying, starts to take a nosedive, and then also at the same time we get a bursting of some of the higher valuations in the semiconductor space, chiefly the AI plays.
Yeah, I'm still kind of curious. I mean, I initially was starting to see a lot of home prices nearby take an initial nosedive, and I think it's just because people are just getting onto the market. But I've seen a lot of the 30-year fixed mortgages kind of coming down into the high sixes at this point. So I feel like the sevens might be over with, and it gets me excited because I have 3 mortgages that are in the high sixes and low sevens. So for me to be able to kind of be able to refinance is good, but I don't know. I'm still teetering onto. I know your thought is that you're going to continue to see home weakness. I'm thinking with cuts, you're going to see a lot more activity in the market. It's going to be very competitive. High priced homes are effed, in my opinion. Right? I think that you're still going to have a lot of competition for first level homes or first time homes and medium level homes. But I just think that bigger homes right now are just going to be completely effed in this sort of economy. So I think if you're having a house that's over probably 2.5 million, it's going to sit, and I don't think it's going to get anywhere. But the competition's going to be fierce. So I'm curious to see if enough people come out of the woodwork to really make it competitive enough where housing prices in the lower price ranges actually stay, or if they actually do kind of come flat, because there is a lot of inventory too. So I'm kind of curious, is there going to be enough demand to help scoop up some of that inventory, knowing that it's in some places like Houston back towards pre-pandemic levels. So it's interesting to kind of hear about. But it's going back to the natural gas piece and kind of the movement of the grid towards natural gas. And you still have Freeport LNG, which is offline, which I think is the big piece.
No, it just got back online.
But exactly. So I think that's part of the reason why the natural gas prices have really been so deflated in the United States, is because that's a huge piece of export. And if you have so much it's not being exported across the US, well, it's a lot harder to be able to move things cross country or X country, rather, if you don't have those LNG plants up. And so luckily now that after Hurricane Beryl, it's literally been over almost a month at this point, And that's part of the reason why I think you saw it, because they were recovering. It was like the $2.70, $2.80 range and climbing towards $3. And really with everything that happened after the hurricane, them being shut in for so long, that's what I think caused natural gas. But oil price itself has been dragging down, right? A lot of these oil companies are reporting Brent in like the 85-ish range. And here we are at Brent starting to climb to the low 80s and even the high 70s in some cases. So it's getting tough out there. And I'm not 100% certain if I was an oil investor, if I would be dipping my toes as of yet. Maybe if you're looking at a Permian play or something like that, yes. But I think things may get worse before they get better in the oil industry. There's just a lot of discoveries, a lot of oil coming online, and a lot of supply still in the pipelines. As we know, like oil prices are still in the mid 70s and OPEC is choked back, right? It's not like they're at capacity. So if they wanted to, they could flood the market and oil prices will be $30 tomorrow. So it's that kind of fear that, you might think that these oil companies are really cheap right now. They're cyclical businesses, right? Just like how I probably wouldn't have been getting into REITs and stuff like that 2 years ago with the rise of interest rates, right? But here we are. The things are the way they are. The macroeconomics are the way they are. REITs is probably a decent opportunity as interest rates kind of get the benefit and the tailwinds, just like regional banks too, right?
Yeah, I mean, right now the market's just going to do what it's doing, which is rotating from mega cap and even some large cap into other areas of the market. So if you look at the heat map today, let me just pull it up real quick. You can see clear as day what actually happened, which was share screen, share. Okay. There you go. Can you see the screen?
Yes, sir.
All right. So you can see majority of the hits today were among the largest caps. Well, mega caps like Nvidia took a big hit. Tesla was down. Procter and Gamble, they probably had a bad report. But you can see that majority of the biggest companies, Merck and Eli Lilly, took a hit. But everything else was relatively green. One of the things that I kind of spoke to the Patreon people, and I'm not sure if you were in that conversation, but basically it was about shifting over from SPY to RSP. I think I spoke about it with Amit last week also, because the thing is, the SPY right now is very top heavy mega cap 8. So, the way that the indexes work is that the index funds, they buy stocks for you and they weight the underlying positions based on the total market capitalization of each one of those individual companies. And right now, majority of the companies that are making up the S&P 500 in terms of total valuation, like is coming from Mag 8. So any impact in the Magnificent Eight's decline or retracement is going to have an outsized move in SPY. RSP is a lot more equal weight. So basically it's just like they have like certain percentages of everything. And, over time they just keep recalibrating, but they don't let, certain positions become overly concentrated. And so if you compare RSP to SPY right now, over the last 6 months, there's been a huge gap in RSP versus SPY. And what tends to happen is that eventually these things will close the gap on themselves. So, this is where you have to just, take a little bit of a breather and figure out like, okay, what am I looking to do right now? So that's why if you look at today, if you just go to the 1-day chart today, you can see that the equal weight was actually up and the regular SPY was down. Right. So you can see that huge difference. So it's almost like, okay, if you took $1, you invested in SPY, you'd be down 0.38%. If you were in RSP, you'd be up. So it's pretty wide difference. So eventually they'll converge on each other, but it's going to be a while before that happens. So
yeah, here's 6 months. Here's year to date.
Yeah.
Some kind of, it's getting
and if
obviously
you go
the last 6 months you said was that go max.
Yeah, if you go max out, the total return on the SPY is always going to be better because
that's also
the nature
offset a little bit too.
Yeah.
Unfortunately.
Yeah. So the thing is, like, a lot of the the cream rises to the top, of course, on the SPY side. But the thing is, sometimes valuations at the top can get really, really extended. So if you look at a 5-year chart, you can kind of see where we are with this. So you can see that they pretty much move in line, but then because of the Mag 8 concentration, that gap opened up, and so that presents us an opportunity. So
yeah. And this might honestly be the fact that Tesla's pulled back so much, right? In 2022, 2023, everything else held up, right? But even still, the big seven did also pull back pretty substantially during the 2022 timeframe, and it wasn't really until 2023 to now things really deviated so drastically. Interesting.
And this is just a short term thing. It's a play on making sure that you're not, and this is primarily for people that want to be in like the indexes, but they don't, they want to be hedged in an index, so they're outperforming the SPY. Well, this is how you outperform the SPY. Sometimes you have to find market volatility and market dynamics that you can't necessarily see that are outside of this. So yeah. Someone's asking, what are the recommendations on REITs and regionals? There's quite a few out there. Not really
it can get scary really quick, depending on what you choose.
I'm not probably going to recommend any individual ones. I'd say if you really I'm not really going to recommend any individual ones, but if you do want exposure to, let's say, regionals, you could buy the KRE. If you want to go a little bit more leverage, you can buy DPST. I don't necessarily recommend people buy DPST. I think KRE is fine. We bought DPST because we're a little bit degen, and it's a very small position for us overall.
Right.
But just I'd say regional banks are the place to be right now. They're still huge. There's still a lot of room to catch up, especially according to Tom Lee, who said, that we were likely to see like about a 40% move higher in the Russell, and a lot of the KRE has a ton of smaller regional banks that have been oversold, in which case their book values they were trading below their book values. I think they're a little bit more fair value right now compared to maybe like a year ago. Oh, especially a year ago. Like one of my biggest winners, by the way, was Truist. Did you see it hit 45 today? So it got to my.
I didn't see it hit today,
target.
but I know it's been on a move.
Yeah, it got to my price target. I was only off by about a month. Like I published this thing last year, and I said, look, Truist is going to be about $45 within a year, and it got to it. I said that it would probably get there by May. It got there in July. So
So are you completely out at that point then, or are you still?
I think
you've been playing in and out of it.
Yeah, I think there's still a lot of room for Truist to do well going forward. They really have right-sized the business a little bit. I'm not sure that the 60s and 70s is where I'd look for, to an exit, so to say. I'd say right now at $50, I think is fair value for these guys. So there's just not a lot of upside. But if you do want to get a good bank with a decent dividend, because even at these prices, the dividend's almost like 6%. Truist is not a bad stock to be in. So, it's like 5%.
Yeah. It was back probably 6% when it was so cheap. Yeah. It's been growing a good bit. I don't know. I think I haven't really looked at this one, but this one's tried and true that people always generally look at with respect to real estate investment trusts. It's Realty Income. I'm fearful of this one because it's involving a lot of CVS's and Walgreens, and at the moment those are kind of struggling at the moment. So I've sold. I used to be a huge proponent of Realty Income, and then I started to see the writing on the wall with respect to Walgreens and CVS is probably 2 or 3 years ago. And so I sold. I had like over 1,000 shares, and I was like happier than a king in shit, right? Because this is a monthly dividend paying stock, and and at the same time I was like, you know what? Interest rates are going to rise. CVS is a Walgreens. So I was like, medium term, I don't like it. So I'm like, why am I in the stock anyway? Right? Because I'm a long-term guy. So I was like, didn't really make sense for me to kind of enter that one or hold on to that one rather. So I sold it and probably moved all that money to the SPY. But Stag is the one that I've been holding on to in terms of real estate. This one is like a big warehouse guy. So I jumped all the way before the interest rate rises up to like the mid 40s. I think a lot of it had to do with Amazon and the success of Amazon post-pandemic, and obviously that was, with 3% or 2.5% of the company's warehouses being Amazon. I think it was dragging the stock along with it in a positive manner. But you're starting to see just the continued dominance, even with the interest rate rises in 2021, 2022, that it's continued to do really well. And so, back up to the $40 range. Will I sell it? I don't know. I was doing a quick calculation. So it makes about 61 cents in funds from operations per quarter. So it's about $2.40. So you do 40 divided by $2.40. It's like a 17 in terms of price to funds from operation. It's not super expensive. It's not super cheap, but it's right in the middle. And so it's like, well, if it's going to be able to grow funds from operations 10 to 20% a year, then it's probably worth holding on to unless I really see something else. So I think I'm just going to hold on to it until I figure out what's going on with these damn interest rates for the next year or so. And then I'll probably offload it if interest rates kind of pause somewhere or anything like that. Because I think depending on how quickly they offload it, I mean, if they offload, 1.5% in the matter of a year, I think that's probably going to be the limit for the stock. It'll probably shoot it to the $55 range, and then I don't expect it to double from there, right? I mean, it's already got millions upon millions of square feet of real estate. I mean, it's really going to only be a 10 to 20% grower every year. So, plus you have to think they distribute stock in order to fund future revenue and future real estate purchases, right? I mean, that's just the art of a real estate investment trust. So it's always going to have a drag on it from that perspective. So I'm holding on to this one probably to the 50s, mid 50s, and I'll probably get rid of it as well.
Yeah, I mean, you have to be with REITs, you have to be very careful because everything is based on the underlying properties that are out there. So, there are definitely a lot of REITs that have not done well. So, you really have to dig. And that's just one of those things you just have to do. So make sure you dig through the thing.
They can be huge debt vehicles, right? And so if you have a bunch of people that are just trying to grow at all costs and don't have the long-term shareholder in mind, or just the long-term appreciation, a lot of people get hot hand syndrome when things are going really well and the environment's really good. But when the environment flips on you, and you don't, all your capital dries up. Unfortunately, a lot of these real estate investment trusts, they get caught with their pants down and ended up in a really bad situation, having to liquidate a lot of things to be able to survive. But somebody had mentioned Brookfield in the comments section, so I just wanted to bring this bad boy up. This is one that Chris has been talking about for the past 6 or 7 months as well. And this is where the fundamentals of BPYPN and BPYPM kind of come in here as well.
Yeah, the ones I'll probably highlight just to put it out there. So here's an example of a office REIT. So this is Office Properties Income Trust. This right here, look at this, 90% down, and it's at $2 right now. So literally lost pretty much all its value. Now, the thing is, the reason why is if you look at the what is that thing called? The properties that they have under them, they have a lot of properties, but a lot of them are pretty much like tier, well, like let's take a look. Like let's say in Texas, right? So they have like places like this. Like look at this, like one building. It's got almost 100,000 square feet. It's probably one of the older vintages. So these are not exactly Class A real estate for a lot of people. These are just like office parks. So a lot of these properties are kind of out of favor right now. Versus if you look at something like SL Green, which we've been in, SL Green, and look at this, has been shooting straight up. And if you look at the properties that SL Green has, let me just put that up, investor relations. You have basically properties in the middle of Manhattan that are like Class A buildings, like One Vanderbilt, that look like stunning skyscrapers, which command like really high rents for a long period of time. So there is a huge difference in the quality of REITs that are out there. So you have to just be very mindful of that and understand that, not every REIT is created equally. So this is why SL Green made total sense, man. It's just a great REIT to be in. So, you know,
that's the
we'll
thing. I
stay
think
in
a
class there,
lot
yeah.
a lot of people think like real estate, right? And it's to an extent, yes, but it goes back to everyone just thinking like, oh, it's an ETF, so it's going to do well. It's like, it's not really the case, right? Everyone likes the term ETF, and I think sometimes the uneducated investor will make the make the wrong sort of statement, and they say, "Oh, I'm an ETF, so therefore I'm okay." It's like, well, there's a difference between ETFs and indexes, and not even all indexes are the right thing to be in either, right? I mean, so you have to really think. I mean, just because it's an index doesn't mean it's necessarily the right index to be in. You really have to think about what you're going into, because I mean, there's a lot of indices. There's real estate indices, there's bank indices, and so sometimes it's the right time to be in a certain index, and sometimes it's not. So you just kind of have to be wary, because I think sometimes people just like, oh, I'm an ETF, so therefore I'm good. It's like, well, just because it's an ETF, it could be a complete, like sector ETFs, for example. A lot of people are like, well, I'm in an energy ETF, so I should be all right. Like oil prices are cheap right now. It's like, well, you have to realize you're investing in the beauties and you're also investing in the beasts. And when you have something like XLE, unfortunately, you're going to have some dog shit companies that are in there that are going to file for bankruptcy. So I think a lot of people, don't take for granted. They might be like, oh, well, right now banks are a good time to be investing. So they might invest in a financial sector ETF. But it's like, what are the companies, what are the holdings that are in there, and what quality of holdings are in there? And I think that's the little fine-tooth detail that will probably save you 20 to 30% certain years, where I think a lot of people, they'll be like, oh, energy's down, so let me get invested in XLE. It's like, no, when energy's down, you want to find the kings and the queens of the industry, right? And hang on to those guys. Like when mining's down, you want to find the BHPs and Vales of the world. You don't want to be in some mom and pop dog piece crap company that won't survive the storm. So, and I think that will drag down the sector performance. Even if the sector itself returns 100%, you're still going to be missing, because a lot of those things will drop out, right? They'll drop out of the market because they go to zero. But yet you'll see all these other companies going up 100%, 50%. And you're like, what? I only went up 20%. Doesn't make any sense. It's because you're being dragged down by all the capital being removed from the market from those dog crap companies. So,
and also, this is not a knock on index funds. I think most retail investors, they're better off buying the indexes rather than trying to pick individual stocks. There's a lot that goes into stock selection that people, may or may not get on their first go. And the thing is, there's a lot of life lessons that you end up learning along the way to becoming much better, a much better investor. One of the things I'll definitely say is just follow the big guys. The big guys, they have especially ones that have developed a good track record. Usually if you see them heavily weighted into a certain individual name, I wouldn't say that you should be 100% confident, but you should at least say, you know what, if the big guys are in this, then maybe there's something there. So even me right now, like one of the things that I do as part of my due diligence is also look at the hedge funds and look at the private equity funds that hold positions in these companies that I'm buying, because it lends just a little bit of confidence to me to say, you know what, there's people right now that spend multi-million dollars in research and analysis to understand what a sector, what this company is doing within that sector. One thing I do want to say, and this is the thing that I hate, I have stopped listening to so many damn analysts, because I think these analysts, for the most part, they're not even doing any real research anymore. All they're doing is just chasing price targets, and literally, it's the weirdest thing.
It's on the news, yeah,
and it's crazy to see that, because it's just like, I here's an example, and I know I'm gonna get shot to death over this, but whatever. Palantir right now, all these people are raising price targets on Palantir, and I'm like, okay, based on what? Like, what do you guys see in that is just not visible right now? And so when I see that, I'm asking myself, like, okay, what is going on? Like, did one of you make a bold prediction that this was going to be $25, $28 like 2 years, like not 2 years ago, but at least like 6 months ago, when the same metrics were coming out and the same things were coming out? No, none of you did. But now all of a sudden you're all bullish on it. And it's the same thing with like Nvidia and all this other thing. So I think what they do is they create these models to basically, like justify their price target. but I don't even know if that's accurate. So Emir, who's a pretty big bull in the Palantir community, he sent me like the price targets for what like Dan Ives has put out for Palantir. I think he put like $50 or some shit, and he's like, Palantir would have to grow at like a huge clip just to even remotely get to that valuation. And the thing is, all these people are looking at that and saying, I need to sell or I need to buy, $40 calls on Palantir that expire within the next 6 months because that's where it's headed. And it's really frustrating to see that, because it's not frustrating if you're an option seller, but if you're an option buyer, it's frustrating to see that, because these guys are basically just throwing money into a dumpster fire, So I'd say you have to be very, very careful. Analysts have turned into CNBC. Yeah, pretty much. So,
yeah, I think it's with anything though. I feel like when companies run, everyone wants to pile in, and when companies are getting attacked, people want to jump for the hills and act like they never were involved with the stock, right? So yeah. I see that all the time. And even Palantir to an extent, like when it pulled back into the low 20s earlier this year, people are like, oh, it's probably going to go back to 15 or $16. It's like, dude, it was just in the mid 20s. Like, where's your conviction? You were the one that was, screaming, buy when it was to 25, 26. Now that it's at 21, 22, you're thinking, oh, it's going back to 16. I should sell. And I think it's just people getting their nerves just like uneasy, and they're not really necessarily thinking about what their true strategy is. They're still flying blind. And I think a lot of that's just confidence. A lot of it's just understanding what your conviction is and why you're invested in a stock. And I think sometimes people just community hunt rather than actually get involved in the stock, because they don't necessarily understand why or how. So like I could look at what Dan Ives put together and be like, it doesn't necessarily make sense. And I remember the same thing being when Dan Ives a year ago, August timeframe, was saying Palantir's going to $25, and I was like, do you think he means for the third quarter? And I'm like, no, he doesn't mean for the third quarter of 2023. Like, there's no reason for it to be $25 today. And everyone is like trying to get all this visibility and trying to like push their elbows out to make it. It's like, no, I could see it within the next year or so, but he doesn't mean the next 2 weeks. Like, what do you mean? What is there actually happening in the next 2 weeks? It's going to jump it from, I think it was like $12 or something to 25 overnight. It's like, it didn't make any sense. And I still think a lot of people act that way. They climb onto it because it gives them a little bit of clout, and they can tag themselves up with Dan Ives, or they can tag themselves up with Tom Lee or whomever, and try to get a little bit of visibility out of it without really having a firm sort of thought. Anyway, different conversation for a different time.
Let me just share something really quickly. This is not a knock at Dan Ives. I think it's a knock at the entire industry in itself, but Dan Ives is a good example of this. So you guys can see my screen. Well, actually, the other one, sorry. Share screen.
And I actually I don't mind what Dan Ives says, but I don't necessarily always agree with his price targets, right? A lot of the things that he says I agree with, but I think his price targets are always a little bit too ambitious, in my opinion.
So if you look at this is Dan Ives. These are a lot of the things that he's rated over the years, right? So the thing is, like, everyone keeps talking about all the companies that are doing, the Palantirs and everything, because it agrees with the narrative. But he's had a ton of ones that he called it wrong, like there's no tomorrow. Like at one point, he had a price target on Nikola of like 180. Heisen Motors, I think he had at one point like a bunch of buy ratings here, outperform ratings, and look at this, it's gone to zero completely. So I'm highlighting some of the stuff that he's gotten wrong, but that's the thing. Like Go EV, right? Canoe, look at this. He had a buy rating at $92. If you had listened to him and said, oh yeah, you know what, I'm gonna buy because Dan Ives told me, and this is in January of 2024. It's not like a long time ago. Okay, look at this, $92 price target, now it's trading at $2. So what does that tell you? It's like, come on, guy.
But is that Dan or is that Wedbush?
Dan Ives. That's him.
Okay.
That's his targets. you know.
Yeah.
So the thing is, like, he comes out and he's hyperbolic because that's what gets him the whatever the viewership or whatever. Look at this. He's had a buy on Rivian since 2021 without looking at any fundamentals. Like, oh yeah, what analysis are you doing to tell people to buy Rivian, who's not generating any revenue, not generating any profits at the time, to buy it? And you gave it an outperform rating in 22, and then it's literally $60 price target, $30, 40, and it just keeps going on and on and on all the way until now. So if you had just listened to the analysts, would have underperformed the market. And it's very similar to what happened with Celsius too. Like, if you look at Celsius, and you look at a lot of the ratings that all these quote unquote analysts gave, the same analysts who are upgrading these things are also downgrading them within the same like 3 months.
Yeah.
Look at this. So this guy rated when Celsius was in, like, I think like the 50s, he gave it a 67 price target, $90 price target, raised it to 95 in March, and then reiterated to 85, and now it's like, oh no, the new price target is 65, and this one. So the thing is, the fucking price targets change on these guys according to the data. So at least I respect guys like this that aren't like the eternal bulls, just saying, oh, you know what, this is the stock price, and it's definitely going to get here. And no, man, so a lot of times people will look at these analysts and put them into this category of, oh, the analysts know what they're talking about, they're always right. It's like, no, they're pretty much wrong a lot.
Yeah.
So
it is. I don't want to say this because this might get me into some hot water, but there's been some people out there, really more so in 2019, 2020, 2021, and maybe even a little bit through 2022, that were able to rest on the laurels of just having a decent position in Tesla and riding that. And because of that, their portfolio gains were X, Y, and Z. And they were able to tout that. Meanwhile, the rest of their portfolio was complete dog shit. And
just like Kathy Wood, bro. We all know you're
exactly. And well, not Kathy. I mean, there's a lot of people that I've interacted with that like still to this day like tout like as if they're king shit, but yet their portfolio since 2022 has remained flat and gone down. And you're sitting there being like, what do you mean? We've had some of the best market. Yes, 2022 is awful for a lot of us. But if you're not up since 2022, you're doing something completely wrong, because the market's been able to retrace and expand beyond that. And have you not been adding any capital? Like, it gets you to think a little bit about some of these people, to be like, well, how in the world has your portfolio remained flat or gone down over the past 18 to 24 months with the markets that we have had? And so I think I've just noticed, and you can be able to call people out. I mean, there's a lot of people that rely too much on some of their individual positions, that 10x or 20x, and then they view themselves because they got fortunate and they did their due diligence on a company and it turned out their hypothesis was right, and they're able to then to sit and be able to act as if they're some sort of oracle. And majority of the time, a lot of their other picks are just not good, and it's kind of sad to see. But my hope is that they come back to reality and take the opportunity to say, hey, I did really well on some of these stocks, and now I can just put it in the index funds, right? And put it in the S&P and just let it do its thing. And, I got lucky, and, I can be mature about that. And because, to be honest, that's where I had to get to. It's like, I can't manage $2.5 million, like, and really be able to focus, like hyper focus, while I'm doing a 9 to 5 and trying to build other things in my life, right? So I was like, well, let me put that money there, and then I'd be able to focus $50,000, $100,000 in some of these other positions, and really nurture that craft, right, to the point where I'm able to be like, okay, these 4 or 5 positions I can snipe in a little bit, or I can really follow it for that 18-month trend, get out and find my next opportunity. That's really where I'm trying to like hone in on. But anyway, I think a lot of times people go through that maturity of their portfolio and still think that they can operate it as if it's only $10,000 still. And I think that gets them into trouble.
And a lot of them also don't diversify either. I've seen too many people with concentrations in certain names because they're like, I'm a long-term investor. I just believe in this thing. And I'm just like, you can be a long-term investor and be diversified, you know? And also, like, when you do sell, people call you out too, like, oh, you're just a flip-flopper. Like, no, the market changed, man. What do you want me to do? You know, like, unless you're paying me basically to hold, I'm gonna sell, you know. So sometimes it's worked out well for me and sometimes it hasn't. But most of the time that I think I've sold at a decent profit, and I've been able to use that capital to kind of reinvest it in things that I have higher convictions in. So sometimes, like I said, it's about your gradual performance over a long period of time, and hopefully that's one of those things that we demonstrated with our current portfolio. Like, what's our total return for the year so far?
Total return, I think we're actually still doing rather well. Let me share.
Yeah,
comparatively to the S&P, we were actually doing rather well. What's your thought before I share?
No, it's just that if you want to beat the indexes, you sometimes you have to move against the indexes too.
Yeah.
So
yeah, 43 compared to 15.
Okay, not bad at all. I'll take that. 3 times the S&P 500. Shit, I think we're doing pretty good.
Not bad, man. Yeah, and that's the thing. I feel like I don't want to jinx ourselves, but if the latter half of 2024 plays out like we think and we position the portfolio, I think we could see 60 to 70% year to date. But I don't want to jinx ourselves because the market is what the market's going to be. So
you just wait until Norwegian and Carnival report. Well, not Carnival. Norwegian's reporting tomorrow, and Carnival usually moves in sympathy. So right now our positions in both. Tomorrow it's either we're going to go down to the 30s, the total return, or we're going to go to the 55, 60s again. So we'll see what happens. But I'm pretty bullish. I'm pretty bullish on the cruise lines. I think the cruise lines
12% for Carnival. That's one of our larger positions in the portfolio. And then 10% for Norwegian. So
yeah.
I have a thought. Sorry, go ahead. I didn't mean to cut you off.
No, just they've got a lot of potential, man. Believe it or not, I'm actually pretty long term about both CCL and NCLH. I'm going to hold them for like 4 or 5 years. Like, I did the math. The great thing about these businesses is that the revenue, the growth is actually very predictable. I know that sounds weird, but it's you've got a certain amount of capacity. You've got a certain amount of pricing power that doesn't usually move up and down. The costs are easy to calculate. And the margins are really easy to calculate because it's a very steady business, even though it doesn't seem like it. And it doesn't have the crazy cyclicality that airlines do. Like, I think of this as a cross between leisure, lodging, travel, all these other things. And at the same time, they're all profitable, So right now the valuations are so skewed to the lower end that I think they've got a pretty fair shot at going higher, especially Norwegian and Carnival. So my portfolio positioning is pretty heavy in both of those names. So
I did have a question for you because I've been looking at this one, and that's not dragging per se, but HIMS. Do you think that this one's a good one to trim at this point, or do you think it's one that you think can continue to go forth? It has been on a massive run. I'll just be honest. This is one that I looked at the $4 to $5 range, or maybe it's a $6 range last year. I wasn't enthused. I thought their marketing budget was too high. I thought maybe they pull back on the marketing budget, they're going to lose all their revenue, and then they're going to spiral out of control. I was wrong. Although I haven't done a lot of looking at their fundamentals, but the stock price obviously has tripled, quadrupled since that point.
I like it. Yeah. Management's doing they're pretty good stewards of capital. They're still growing. I think, we're not overly exposed to it. What is it? Barely 3% of our portfolio. So I'd say leave it. There's not really much. We already extracted majority of the short-term profits off of this thing. So at this point, the only thing we're really playing with is maybe a little bit less than the principal that we had.
That's true. I think we bought 15 shares maybe back then. Climbed it from like the $10-$12 range to the 20 or so, I think. So I could be wrong. I guess our call space was 13. So
Yeah, I do want to eventually maybe create a separate portfolio that's just dedicated towards income / capital appreciation, because I think this is like, I think the next 6 months are probably the most ideal to create a retirement portfolio for people. What I mean by that is that, you know, there's a subset of the population that needs capital appreciation, and there's a subset of the population that needs fixed income kind of like things with very little volatility. So I think developing a portfolio, even if it does underperform the SPY, what we want essentially that portfolio to be like is a income generator with a little bit of capital appreciation layer on top. But the key metric, the key focus on it is going to be like lowering the amount of risk. You know, so how do you lower risk? Well, number one, you find companies that are more like, you know, that are a lot more, what's the word, safer with terms of revenues. They're elastic. They're like, the consumer doesn't have a choice but to pay, like utilities, right? If you try to beat the S&P 500 using utilities, you won't do it. It's not going to work. Like I can tell you right now, there are very, very few utility companies that trade with so much undervaluation or even overvaluation where you could theoretically short. Utilities is one of those things that you just buy during periods of weakness in the economy, so that you can ride out the recessionary wave. So someone who's like in their 60s, you know, they're looking for good fixed income, but at the same time, you know, they don't want to go crazy on the risk side. I think utilities would be a great place to buy right now, because when rates go down, the dividends that you guys are going to be getting, plus the marginal increases that come every year, you'll still do well, you know, and you'll be able to kind of live a good life, because there are people that need that fixed income kind of coming in. And so a lot of people were asking me about BPYPM and BPYPN, and you know, they're good, but they're not as safe as, let's say, like a PG&E and, you know, and a utility. Altria Group, I know, god damn it, what's his face? Steven, man. Yeah. I just, the thing is, I like the business, okay? Like, all business wise, the metrics work really well. The problem is my morality will not let me buy these things. I just can't do it, you know.
And the reason why this one's doing really well, so you know, it hung out and it went down. It's not a very large growing business, right? If it grows by share buybacks and everything the like, you can see, you know, keep in mind, Altria Group is one of the best performing stocks of all time, right? Especially if you include all the spin outs that it's had with Philip Morris and Mondelez International and Kraft and all that. I mean, you think about it, that used to be all one company back in the day. So if you consider all that, I mean, it's one of the best performing stocks of all time. I remember buying it, you know, and chasing it to $17. And eventually I think I don't remember how many shares, but I had a lot of shares back at $50, probably in this 2018, 2019 timeframe. And I was using it for the dividend. And eventually that's what I started transitioning more towards the Googles and the Amazons and stuff of the world. The reason why I think you're starting to see this turn around right now is really heavily due to, and it goes back to what Chris was talking about, the dividend, and people recognizing it's a 7-8% dividend. And people are now sitting here, maybe some of the elder folks that are looking for that steady income, something that's going to be around. Yes, is smoking shrinking? Yes, but it has been for God knows how long, and yet the stock has been continuing to grow based off of share buybacks and being able to increase revenue per pack that they sell and everything the like. But it goes back to, hey, it's a 7-8% dividend yielder. You're not going to be able to get these sorts of easy 5-6% rates of return on bonds and in savings accounts like you were over the past 18 months. Where am I going to find that super easy money? And the answer is something like an Altria Group, something like a, let's see,
look at Waste Management. That one is the one that, like, literally it's up and to the right.
Yeah, Waste Management's always been an absolute monster.
You know, you didn't have to like speculate on anything. Look at this. It's just from $25 10 years ago to almost that. So it's a 10x.
10x over the past 25 years. Yeah. And even the past 5 years, it's a 70%. The past year, it's 23%. But all this whole time, you're getting a very steady, you know, growing dividend, a 1.45% dividend, and it's 10x.
Okay, so let's talk about the dividend. I think one of the crazy things about dividends that people may or may not realize is some people will look at the dividend today and say, it's only giving me a 1% dividend. I could put my money in a treasury and I'd be better off, right? The thing with dividends, and this is the part that people miss, is that dividends tend to grow over time. Your cost basis doesn't. So as an example, if you bought a company who's basically has been increasing their dividend over a long period of time. So let's take an example. Let me just share my screen.
Really even the S&P 500 is a good example, but yeah, I'm curious to see what company you choose.
1 second. So okay, share screen. Okay, can you see this right here?
Yeah.
So you look at this, American Tower, okay, AMT. Right now, the current dividend is 2.91%.
That's garbage, Chris. Garbage, blasphemy.
I know. At $223 a share, it's $6.48 per year, which translates to 2.91%, right? So some people say this is not what I want. But the thing is, like, imagine right now you had bought this thing, right here. Like when it was,
and you're still getting a 2.9% dividend. Oh,
right?
man.
So if you think about it, if you bought this, let's say even in 2008, when everything crashed, whatever, right?
Was that $30?
It would be $30 a share. So your cost basis is $30 and you're getting a 6.48%. So your dividend yield is probably
6.5 cents. $6.50 for your dividend right now, and you bought it at $30.
Right. And then if you look at it, the dividends always are slowly increasing. So you can see here that, back when this thing was around that time, it was like 35 cents a quarter in dividends. Now it's climbed all the way to $1.62. That's why if you look at Warren Buffett, that's what Buffett does. He just buys and holds companies like this. Now, how does AMT make their money? Well, AMT makes their money in a very, very simple way. They basically build the cell phone towers and just rent them out to Verizon, AT&T, Sprint, whatever. And then what's good is that the business has fixed elevators in there. So basically what happens is it says every year the rent goes up by 2% or 3%. And what ends up happening is by year 20, the rent has gotten to the point where it just keeps compounding on itself. And I know that's like that with a ton of businesses too. Like you buy a business that has like a 6% cap rate, like a property that's a triple net lease. So you're getting 6%, which a lot of people will be like, 6% is garbage. Like I don't want 6%. I'm taking all this risk, blah, blah. But the thing is, the property, you don't manage anything, you don't do anything. And they also have in the lease agreements, like a 20-year lease, but it'll be in there that you have like a 2.5% rate increase in rent every year. So what ends up happening is, yes, year one, you're only getting a 6% return, but then the year after that, you're getting even more. The year after that, you're getting even more. The year after that, you're getting even more. And then the impact of compounding returns comes in. And now all of a sudden you're killing it,
Yeah. So. This is a perfect example with the S&P 500, right? Because people might be like, the SPY, why would you invest in the SPY for dividends? Right. And the thing is yes, it might cycle between, let's just say 2.5% to 1%. But if you think about it, it's always staying in that 1.5% to 2% range. So even in the best of times or the worst of times, your payout is always consistently growing because the SPY itself is growing. Right. So you think about it, it's like it was at a 2% yield back in 2011. The SPY itself was below 1,000. The payout was $1.70, $1.80 per quarter. And now here we are. The SPY has since gone up, 5 times that point. The payout itself is 5x itself as well, and the yield is, a 1.5% to 2%. I don't know what these last 2 or 3 payouts are. I think these are wrong, but regardless, it just goes to show you, like if you're investing in the right companies, like Google, for example, if you think about it. Google just initiated their payouts and they're started extremely small. Even still, it's $2.5 billion in terms of dividend payments. And same thing with Apple, right? Apple's like, oh, well, it's only, a 1% dividend payment. 1% for Apple is $30 billion. So you have to think like this is a lot of money. And not only that, but Apple's probably a really good one to look at because people might say, well, they initiated their dividend really, really small, back in 2012 timeframe. But look what's happened, right? Their payout ratio has grown. Actually, it's pretty substantial. Over that time period, but their dividend yield started off, at 2% and it's really just because of the price appreciation has continued to kind of remain below 1%. But this entire time, they've gone from an initial dividend of 16 cents, and over the past, I guess, 12 years, they've been able to like quintuple it pretty much in that time period from 16 cents or so all the way to 97 cents per share. And it just goes to show you, the power of investing in good companies that take it almost as if, it's the trick that I've observed is that there's a fine line a lot of times with companies, and it really goes back to what you're investing for, right? Are you investing for growth or are you investing for high dividend income? What exactly are you investing for? Because you can go to the extreme end for dividends, and companies that pay way too high of a dividend yield. A lot of what I've been showing you is 1 to 2, 3% dividend yields, but you can get to the place where you get into these companies that are paying 7, 8, 9, 10% dividend yields, and they end up being yield traps. You end up basically getting caught, and then the stock just basically tumbles. They either cut the dividend or they go belly up because they start bloating themselves with debt in order to just pay the dividend, things like that. So there's a lot of, it's not as simple as just find a company and kind of pick it and run with it. But there's some really good examples out there of companies that have low dividend yields. And the reason why they're low is because they're slowly growing it over time, but the stock prices continues to mint.
Yeah. Hershey's is another one where someone put in Procter and Gamble. These are all businesses that, you just buy, you hold, and you'll get dividends. You can reinvest the dividends and keep compounding yourself. It's such a, like, literally investing with companies like that is such a no-brainer. The question, and by the way, the other problem that I see a lot of investors make, they'll look at the chart and be like, it's gone up and to the right. I don't want to buy it because it's already at the top. And the thing is, that's not how the fucking market works. There's just everyone wants to like buy the shitty company sometimes and think that they're a value investor, where it's like, no, just buy the high quality company, man. Call it a day. It's like, no, I want to buy the company that has an 8% dividend, but is a shitty company. But I will avoid the 1% dividend company who's already gone up 200%. But the thing is that 200% is a strong business. But I don't want to buy that. I want to buy the shit company. Like, no, don't do that. Don't buy the shit company. Buy the good one,
I always think it's funny. Like people are always like, oh, I'm not going to buy because the market's at all-time highs. And it's like when, very rarely over the past, goes back to 2000, right? When wasn't this at all-time highs, right? It's just like, exactly. so it's like, I love it when I hear like, and they're like, oh, no, Google's at all-time highs. Like, it's like, Google has always been at all-time highs. Like very rarely, like let's pull it up since 2004, since it's been on the stock exchange. Like when hasn't Google, been all-time highs?
All-time highs, yeah.
And it's like maybe since like that rare period between 2022 and maybe that rare period in 2008 and 2007. But every other time, it has been all-time highs. What about Apple, right? Like when is Apple or Microsoft? Or it's like, people that say something like that, hey,
hey, listen, I've done that myself. Okay, so
I have too, very early on, right? But I'm just saying, like, it's part about that educating yourself in the market, right? And you think you're smart enough because you know a little, but you're not smart enough to know that you don't know anything.
My problem is
be cautious of that.
My problem is sometimes in the past, I would look at the market cap and be like, this is a $50 billion company. Wow, that's the market cap's like too much, man. I don't want to buy that. And it's just like, bro, market caps are relative to the stock. Okay. If the company is doing a shit ton of share buybacks, the market cap can stay flat for the next 5 years and the stock price will shoot up 10x. you know, because they just keep buying back shares. And that's the flavor of the day these days anyway, where tons of people, tons of companies, they realize the best thing that we could do is instead of trying to issue a ton of dividends, just buy back our stock, you know. So even if our market cap is not that, you know, not that attractive in terms of going up, the stock prices. So you have to disassociate sometimes between stock price and market cap, and sometimes you have to reassociate there. And market cap gives you a good idea. I mean, there's multiple ways to pick these things. So the Dunning-Kruger effect is real. I wonder what the Dunning-Kruger effect is.
I don't even know. I'm afraid to look it up.
Dunning-Kruger effect.
Chris is going to get us in trouble.
No, it's fine. It's cognitive bias. It's a very interesting. I'll read upon it. Right here.
That actually sounds pretty good.
Yeah, right here. Actually, let me close this. Go back. No, I don't want to subscribe to this. Yeah, whatever. But yeah, I'll look that up, Otto. Thank you for that. Yeah.
Cool. I think that's a good place of any. Jerome speaks tomorrow. Are you? I know Sam is on Amit's morning open tomorrow.
Yeah.
So be sure you guys check out Sam. He's a good friend of the channel, also part of Chris's Patreon, and they're actually doing really well as well. You just started the second episode of your podcast with Sam. You want to give that a quick shout out?
Yeah. Me and Sam are working on basically creating another. Even though I got called a podcast whore because I keep appearing on everyone else's podcast.
Who called you that?
That's someone in the comment section on Twitter. It doesn't matter.
I was wondering if it was the boss lady that called you that.
No. They were just like, oh, you know, why do you join other people in podcasts? Like, why don't you do your own? And I'm like, well, the thing is, like, I don't like talking into a camera, man. Some people can just, hey, everyone, how's it going? Let's talk about this stock for the next hour and a half. Like, I can't do it. If I'm not talking to a person, bro, I'm done. So I can't do it. I need to have another person on the other side. So
I was actually so give your podcast a shout out with that.
Yeah, it's called The Hidden Edge, where basically me and Sam are going to be dissecting companies fundamentally and maybe even some sentiment analysis to see if we can figure out, you know, if there are great places to be. So it's more for active market participation rather than being very passive. And so Sam's got a pretty good handle on the tech space because he works in the tech space. And so we want to just kind of combine our opinions together and see if there's a way that we can, you know, get the best information out there. And so sometimes we'll agree on things and sometimes we won't. And I think that's probably one of the best ways that you can invest, is that you need a contrarian voice within your team who's going to be able to challenge you, but then also agree with you when it's necessary. So it's this back and forth that gives the best ideas, you know, and the best ideas tend to rise to the top, and then you put them out into the world and see where things go. So
very good. Yeah, and join Chris's Patreon. Link is in the description as always. It's a lot of fun, a lot of good conversations that go on in there. So if you guys ever are curious, feel free to give that a look. I'm trying to think. Mr. Powell speaks tomorrow. Curious, Mr. Patel, are you good for Thursday, or do you need to wait till Friday, or what have you?
No, I think we're good for Thursday.
Yeah, I'm trying to think if there's any other news between now and Thursday that we need to.
Not really. The one sad thing is, I think the summertime, there's just not a lot of great news that's out there that we can really speak much about. The only thing that I would caution people is, you know, earnings week is this week, but just have some idea of, like, okay, how is the macro going to impact this company, regardless what these people say on their earnings statements. Earnings is a way that they can highlight the things that they want you to see, while kind of like putting things that they don't want you to see on the side. So today, like an example is Anthony Noto with SoFi came out and said, oh, look, we had a record-breaking quarter. Everything was doing really well. And so we got to ask a question about Galileo. And I was like, oh, no, blah, 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 blah. So it's like, interesting, you know? So you have to kind of piece through these earnings to figure out, like, okay, what are they trying to hide? I always go into these earnings calls with the skepticism, because I feel like if there is something wrong, you'll probably detect it, there. And the thing is, if you just base your entire investment thesis on the numbers they give you, don't do it. Just, you need to go into the SEC filings and look there, man. Don't look at their stupid graphs and their presentations that just give the rosiest pictures. No, go and do your own homework, do some due diligence, and you'll do well.
Yeah.
And man, how many Discords you got?
I don't know. I need to leave a lot of them. I keep getting invited.
I have like 3 total.
Yeah. So investing at all-time highs versus all dates. This is the ETF FaceTime that sent this one to me.
Nice.
So you can see average 1-year returns. So all other dates, basically not much difference between the other two. Only at all-time highs, 11.2%. So the majority of the time, your returns are in the first year, 11.2%. In the 3-year average, 10.9% versus 11.5%. So you're only getting a 0.6 difference by being at all other times, if I'm reading this correctly. And the same thing with the 5-year, you're getting 10.5% versus 11.3%. So the majority of your time is made, or all your money is made at all-time highs. That's pretty interesting. And I've seen another similar stat as well, where it's like the majority of your money is made overnight by holding the stock overnight. Like the S&P, because if you think about it, the S&P will open up at like 0.5% up, and it'll end at 0.5% or 0.55% up. And it's like, well, if you waited until the market opened, you'd only be up 0.05. But if you held it overnight, you'd be up 0.5%. And so I've seen a lot of those statistics as well. So cool. All right, Mr. Patel, you're the man. I'll chit chat with you come Thursday.
Yep, sounds good.
Cheers. All right, everybody. See you next time.
Bye.
Greed is good.
The stock is going to go up, down, sideways, or in fucking circles. It's all a fugazi.
Sell it all.
Greed is good. Huge upside potential, upwards of $60,000.